Welcome to Economic News Desk. For August 26, 2026, we are tracking two massive, structural shifts in how global capital and power are being deployed. The rapid repurposing of digital infrastructure from Bitcoin mining to artificial intelligence, and an escalating economic war between the United States and Iran that is threatening to reshape global trade and energy markets. We begin with a significant reallocation of computing power. For years, the massive energy and hardware investments in the crypto sector were driven almost entirely by the pursuit of Bitcoin. But as the economics of mining change, that infrastructure is being redirected. While Bitcoin's price has seen a recent rally toward $80,000, it remains significantly lower than the peak of $124,000 seen in October of last year. This combination of lower prices and reduced mining rewards is driving a pivot toward high-performance computing to feed the surging demand for AI processing. This isn't just a temporary adjustment, it is turning into a permanent shift in the landscape of data centers. For instance, Riot Platforms has signed a $9 billion 20-year compute deal with Anthropic. Similarly, Enegix is planning to transform a significant portion of its business, including its infrastructure in Kazakhstan, to serve the AI market. These transitions are incredibly capital-intensive, forcing some companies to sell off their Bitcoin holdings just to fund the necessary hardware upgrades. Industry analysts suggest this shift may be difficult to reverse. The cost of refitting a crypto mine for AI is substantial, and the move toward long-term GPU colocation leases provides a level of steady, multi-year revenue that the volatile crypto market simply cannot match. While some firms are moving fully into the AI space, others, like Bitdeer, are pursuing a dual-purpose model, using flexible Bitcoin mining to supplement the stable, long-duration income provided by AI workloads. While the digital world undergoes this reconfiguration, the physical world is seeing a high-stakes escalation in economic warfare. Nearly 6 months into the current conflict, the United States has shifted its strategy from curbing Iran's nuclear ambitions toward a policy of total economic isolation. The goal, according to recent reports, is to pry control of the Strait of Hormuz away from the Iranian regime. Treasury Secretary Scott Bessent has signaled that this will be a massive financial offensive. The Treasury has targeted a wide range of sectors, including digital assets, technology, gold, aviation and shipping, and has imposed sanctions on nearly 60 different entities, individuals and vessels. Crucially, the US has issued a warning to the rest of the world. Any nation or business that continues to partner with Iran should expect to face isolation themselves. This is a move designed to close the loopholes that have historically allowed for smuggling and sanctions evasion. However, the effectiveness of this isolation depends on whether the rest of the world is willing to comply. We are seeing a split in the international response. The United Arab Emirates has announced it is halting all trade and financial transactions with Iran. But China remains the critical variable. While a US naval blockade has already caused Iranian oil imports to China to plunge by roughly 40% compared to pre-war levels, China remains Iran's largest oil buyer and has historically ignored unilateral US sanctions. Experts warn that if the US moves to sanction Chinese entities to force compliance, it could jeopardize broader trade negotiations with Beijing. The human and market costs are already being felt. In Iran, the domestic impact is severe, with the cost of basic necessities like rice and milk now consuming a significant portion of the average monthly minimum wage. On the global stage, maritime shipping costs have surged, jumping from $3,000 to $12,000 per container. This tension is also putting upward pressure on energy markets. Brent crude is currently trading at $92 a barrel, and US gasoline prices have exceeded $4 per gallon. As the conflict continues, the risk of escalation remains high. Iranian security officials have threatened to retaliate by targeting tankers to disrupt regional oil exports if the pressure persists. Whether the US can achieve its goal of isolation through financial means, or whether it triggers a broader disruption in global energy and trade, remains the central uncertainty in this escalating confrontation.